What is up, everybody? Welcome back to another episode of Fed Watch. I am Ansel, Lindner, and I'm coming to you from an undisclosed location in the Smoky Mountains. I am here with a special guest co-host. The last few weeks he's been on too, but Nolan, how are you doing today, sir?
Ansel, I love life. And if we want to jazz up where we're staying, I can disclose my location. It's actually amazing. I am, no kidding, staying in George Washington's former house in
Wow.
Barbados. I've been living here all winter. It's now what happened was it was a scam. There's a museum just down the road that's called the George Washington Museum. He came here indeed because when his older brother, from whom he inherited Mount Vernon, had tuberculosis or whatever, he came down to Barbados to get the nice air. Now, there is a museum up there, but they don't let the sick people stay in the main house, right? So that, like, obviously, so he came and stayed down with his brother in actually the house that I'm in. And if you read old Bajan tourist books, you'll see that George Washington, this was a tourist attraction. It's all hidden now in the past, but it's pretty fun to be here as we see this chaos and to be sitting in George Washington's chair is pretty fun.
Yeah, I mean, speaking of American history, there was the number two and number three largest bank failures in American history just happened this week. So we're going to be covering that. I am on family vacation, but I had to make sure we got a show in this week because so much has happened. Let's see, what are we all covering today? I did send you the little outline of the stuff we're going to talk about. Of course, Credit Suisse, that's a big one. We're going to talk about Silicon Valley Bank and Signature Bank. Is there a choke point, the crypto choke point, like some people are talking about, or is this all hype? Of course, the CPI came out this week in the United States, as well as the PPI, which stands for Producer Price Index. That's kind of the leading indicator, or it's upstream from consumer prices. So we're going to look at the PPI real quick and look at charts and see what it all means. See if you and I can hash out some sense what's going on here in the Bitcoin space. So make sure if you guys are watching there on Rumble, on YouTube, on Twitch, on Facebook, wherever we're sending this out to, our multiple channels, make sure you like and subscribe, comment. It helps other people find the show. The last few weeks we have had huge numbers with Rumble. So YouTube, you got to pick it up. Guys, share the link, comment down below. Appreciate everybody that supports the show. Nolan, do you have any plugs from your content?
Indeed, we host every morning. It does come in Rumble on replay, but we go live on YouTube and Twitter for the breakup. We just look at the economy as if it's a psychological engine, and we look at stuff like this morning. What did I name it? I said Yellen, the bank system is safe, might backfire. So if you yelling that the bank system is safe, it might not work, right? You don't want to be yelling in a crowded room with a fire, and so that's what we got today. So it's all about the psychological stuff that perpetuates it. And I do want to say before we get into it, Ansel, you were one of the first people that rang the alarm on this bank run last Thursday when we hosted the show, when it was still maybe, and we don't know, it was kind of Act One, right? We weren't really down the road yet. And you called the weekend and you called Friday a full 24 hours before this stuff started. So you keep getting it right, Ansel. I gotta always mention when you get it right. You know, I'll mention to the audience when you get it wrong, but I continue to be amazed about how right you're getting some of this stuff, because you got the Bitcoin bump that the ordinals seem to have produced back in January. You were mentioning on the show, and I didn't see it coming. You saw it coming. These bank runs, I thought, they're just gonna wish it away and use their words and make it all go away, as maybe they have. But you were the first to say this is real and it's coming, and there's more coming. It wasn't just Silvergate. So bravo again, Ansel.
Thanks. Yeah, I mean, if you can be right 50% of the time, you're doing pretty darn good in this business. So you got to make sure you double down on your successes and you cut your losses on your failures. But yeah, thanks for that. Last week we talked about, what was it, Silicon Valley Bank, and we talked about.
It started with Silvergate. You were the one at the time. It was only Silvergate that was in discussion, and we were still just in the bank run phase where Peter Thiel had said to his folks, you know, I think something's coming. My best advice is beat it. And the Silicon Valley stuff had only been in the projection stuff. So what Janet Yellen was saying this morning, right, yelling about the sound banking system, we had the CEO of Silicon Valley who was trying to tell us all, don't worry about it, we're great. And so that's where we were at last week.
Yeah, and Credit Suisse. I mean, that's going to be our first story, so we can just jump right into that. Usually, we start with Dick Insights and stuff. Go ahead.
Oh, you got to get the audio up a little bit on that, Ansel. I missed it.
Okay, I'm doing my best here, guys.
That's
Sorry for any
perfect. That's
audio
perfect.
issues. But okay, so yeah, let's start here with Credit Suisse. Um, this is not a surprise. Okay, they've been having problems for years. This is a story that's out of Axios, and I thought they did a really good job summarizing it. So I'm going to read through a little bit of this. Credit Suisse, the 167-year-old banking behemoth, is not a domino falling in reaction to bank failures in the U.S. Its troubles are of its own making and have been cascading for over a decade, and more than that, we'll see here in a second. Still, its current dire predicament could hardly come at a worse time for the global financial system. Why it matters. Credit Suisse is one of just 30 global financial institutions designated as being systemically important by the International Financial Stability Board. In other words, it's too big to fail. And I wanted to put an emphasis on this. So, yeah, it's a globally important bank. And why they would let Credit Suisse get this designation, as you'll see in a few minutes, we're going to go through the history of corruption and just horrible practices that Credit Suisse has been involved in. Why is it still as important as it is? Okay, by the numbers, Credit Suisse had total assets of 574 billion at the end of 2022, down 37% from 912 billion, so almost $1 trillion bank at the end of 2020. Its asset management arm supervises another 1.7 trillion in assets. Those numbers dwarf anything seen at Silicon Valley Bank, which had total assets of 212 billion. Credit Suisse's assets are almost certainly lower today, the specter of a messy nationalization looming over it. And clients have been long departing it for institutions seen as much more stable. Flashback. Credit Suisse has been scandal prone for decades. And the next one, producer Chris, I wanted to bring up is the next slide. This is a story out of The Guardian from last year, February of 2022. And what this story does is it details out the long history of corruption and abuse of specifically Credit Suisse. So it goes all the way back to 1986. They used fake names for Ferdinand and Imelda Marcos. Then in 1999, they had a Japanese shredding party. Japanese authorities fined Credit Suisse and revoked its license over a shredding party at which bankers destroyed evidence related to an investigation into whether it was helping companies conceal their losses. In 2000, it was embroiled in banking funds linked to the Nigerian dictator. In 2004, money laundering for Japanese gangs, Yakuza. In 2009, U.S. sanction breaches. Credit Suisse was fined $534 million for deliberately circumventing U.S. sanctions against countries including Iran and Sudan between 1995 and 2007. In 2011, they had a German tax evasion scandal. In 2012, U.S. subprime bond fraud. 2014, U.S. tax evasion. 2016, Italian tax evasion. In 2016, U.S. anti-money laundering fine. In 2017, anti-money laundering fine related to 1MDB. In 2017, European tax evasion. 2018, weak controls linked to dealing with Petrobras in Brazil there. They stole money from many high-profile clients, and that came out in 2018. They were actually investing clients' money in personal accounts of the bankers. So that was a pretty big scandal that came out in 2018. Also in 2018, they got sanctioned by the Hong Kong Monetary Authority. In 2019, they had a corporate espionage. In 2020, Bulgarian drug trafficking charges. 2021, Archegos collapse, and we reported on that here on FedWatch when that happened. Also in 2021, Greensill scandal. Credit Suisse was forced to suspend $10 billion of investors' funds after the collapse of a supply chain lender, Greensill Capital. Also in 2021, Mozambique tuna bonds. So they invested something like $10 billion in these tuna bonds. Most of it got siphoned off by the politicians in Mozambique, and the Credit Suisse employees, or the C-suite people. In 2022, the chairman resigned. On and on and on. You can just go on and on with this bank. So we saw this coming a long time. It wasn't like just overnight that this banking failure, whatever you want to call it, crisis struck from Credit Suisse. So, Nolan, do you have any insights on what you're thinking is going on here with Credit Suisse?
Yeah, so indeed, the slow moving train wreck that is Credit Suisse indeed has been having trouble for many, many years. But I do want to point out, and I covered it on my show this morning, Isabella Kaminska's article. If you guys don't know who Isabella Kaminska is, she's she likes to pour cold water on Bitcoin, on the whole scene, but she's an honest debater. She has come to Bitcoin Amsterdam, which we hosted last year. I'm not sure if she's coming to Bitcoin Miami, May 18th to 20th, but she's a welcome personality and is not afraid to say unpopular things. But she made one of the most amazing observations about this. It's real, it's rare I say this, but this was actual top tier journalism. And she compared the bailout, and that's what I focused on, what's going on with the Swiss National Bank here, because of course it's not the Fed Bank, it's not the US Fed Bank that's involved, because it is a Swiss commercial bank. So it's the Swiss central bank that ended up being involved in this. And what she likened this bailout backstop to is exactly what happened with the Terra Luna scam. Basically, they had a mismatch of maturity. In the case of Terra Luna, it was the way that Do Kwon had created the stablecoin, really to buttress purchase of the Luna, whatever, Terra crypto coin, whatever the hell it was. But the point in this case, the analogy is that all of this money to backstop is actually going to the share price. This is a big share buyback scheme, right? So it doesn't matter how much you've mismanaged the actual treasury. And it's a huge treasury, much as it was in the case of Terra. It was a huge treasury. And the whole design of this algorithmic stablecoin, or whatever voodoo magic they had decided was the new thing back a year ago when Do Kwon was launching this. And it was like 25 billion backing or something like that he'd thrown in, Bitcoin and a mix of stuff. But the point was that it was sitting duck, and the price of the actual coin, Luna or Terra, I don't remember which one it was. Who knows what's going on there? But the point is, the mechanism was to support the price of the coin, not the stable coin. And in some ways, this answer is what's been repeated here by all the serious people, the central banks. All of these guys basically decided, because it wasn't Do Kwon and a crypto shitcoin, that because it was a bank and had a bunch of depositors, that the situation was totally different. And Isabel Kaminska, to her credit, points out that it is much the same thing. It would be as if we bailed out the Terra coin in order to save a stable coin a year ago. And when you look at it all, it's been almost a year since this thing. And it didn't really look like there was a solution, because, of course, the American solution now to SVB, the Silicon Valley Bank, and Signature, and we'll keep talking about it, was just to backstop deposits. It had nothing to do with the share value of the banks, which has crashed to zero, I guess. And it's funny that that's what the answer here was, the opposite of this American solution to the particular banks in America. It was to make sure that the share price itself was backstopped. So very interesting development, and I think congratulations to Isabel Kaminska, who even called it the Kobayashi Maru. She compared it to the Star Trek maneuver, the game that William Shatner reprogrammed in order to lose the simulation or win the simulation. So very interesting stuff. I thought it was a great take.
Well, Isabella has a long history with Bitcoin. There was that Mt. Gox documentary, I think it was 2013 or 14, and she was in there. She was the one from the Financial Times that did an interview. So, yeah, she has had a long history of Bitcoin. And, yeah, she has great stuff. So more of the details. The Swiss National Bank, they came out and said, we're going to do a bailout of $54 billion equivalent. It's probably Swiss francs, I'm guessing. But $54 billion worth of a bailout. And that's supposedly going to backstop the bank. I think my reading of this is that it's, kind of like in the great financial crisis, you had Lehman that hit in March. Or no, you had Bear Stearns in March and then Lehman in September. So this, I don't think, is going to be immediately followed by any sort of market rout. And we're going to take a look at a few charts and see if that is the case. But we didn't see stocks crashing. We didn't see Bitcoin crashing. We didn't see this big sell-off in all these risk assets like you would expect from a major, globally, systemically important bank. Having to get a bailout, you would think everything would crash, but it hasn't done that. So any more on Credit Suisse, or should we roll on to the Signature?
Yeah, let's roll on to Signature because there's a lot to cover today. It's a choppy day out there.
Yeah, so Signature, we talked about this, was it last week or 2 weeks ago? And you said that this was a big thing with Kraken. When you were with Kraken, weren't they using Signature and Signet?
Yeah, I think a lot of people were. It was a lot of the exchanges just appreciated the rails that were built because they were sort of endemic to the industry and it didn't involve Swift and Wire and all these other things. So, or however else these guys were settling up at the end of the day. So, I know that we even, headhunted the guy who helped set it up at Signature in order to help us leverage it more. For what reasons, I'm not totally sure. I know it wasn't about keeping an account there necessarily. It was about using these rails to settle transactions. So
Yeah.
I don't know it was just sort of newish when I was there, but it definitely was a thing.
Yeah, I thought that was interesting because we did talk about that exact subject on the podcast here. And then that is now in the middle of this about rescuing Signature, and maybe they're not going to bring back these Bitcoin rails. So, anyway, this story that you're seeing here on the screen, Barney Frank, he was a co author of the Dodd-Frank Act, and he was also a director at Signature. So, he has his fingers all in this. But he gave an interview here to what outlet is this? New York Magazine. And Nick Carter tweeted out that what Barney Frank said here is, Barney Frank is blaming this whole thing on I guess, discriminating against Bitcoin companies, the Bitcoin industry, which some people call crypto, but they're discriminating against these Bitcoin rails, and Barney Frank is blaming it on this. Of course, there's a bunch of other opinions, and one of them that is near and dear to this show is David Bailey. He had some great commentary that I wanted to bring up. So if you go to the next slide there, producer Chris, please. So David Bailey here, he said, it's absolutely wild that the FDIC bailed out the crypto industry in an unprecedented action, and the industry frames it as an attack. I guess 3,000 plus companies would have gone bust. $25 billion in deposits. Poof. Wholly unacceptable central point of failure. Or sorry, honestly, unacceptable central point of failure. Industry must reflect. And then he had a back and forth with Nick Carter. And if you go to the next slide, this is what he tried to respond to Nick Carter, because Nick Carter spreading all these theories out there about, hey, this is an attack, because he kind of coined, I think, this Operation Choke Point.
2.0, yeah, it was Choke Point 2.0, and he predicted it. We always got to mention predictions. You've been getting a lot right. He did predict this scenario. Now, that can lead to narrative bias or confirmation bias. That's the kind of content I cover on my show every day. How you'll see what you want to see if you've already predicted it'll be there, usually, right? And it could be what we're seeing here.
Well, right, but David Bailey also predicted this. He months ago when we had the FTX collapse, he said in a tweet that next up is going to be Silvergate, and after that is going to be Signature. So he predicted exactly this. But this is his response to these theories by Nick Carter, which I think are self-serving theories. Nick Carter is a big crypto, shitcoin investor, and so he needs to be in there and calling this out as if playing the victim to get help from, I guess, regulators, and we'll see they might be getting that. But Nick posted this about Signature, and I wrote a detailed response, and then he, of course, links to an image down below that he's talking about. So David Bailey says, number one, if you notice his statement, it's a political response, and he's talking about Barney Frank. He's not definitive. He has a massive incentive to deflect blame as he has liability as director, whereas I have no liability and no reason to lie. Number two, I have the only evidence available, their financials. Look at their 10K and Q4 results, and then tell me when they could have come up with an additional 20 to 30 billion in liquidity to cover the loss of deposits. It's not possible. They were insolvent. You can walk, or I can walk you through the financials if you'd like. Number three, the regulators themselves said it had nothing to do with Bitcoin or crypto. Maybe they're lying, but I don't know why you would believe Frank over them. Number four, their founder and longtime CEO stepped down unexpectedly with a 1 week transition period last month. Number five, look at their stock price. Do you think they were trading at all time lows because investors anticipated the government unfairly targeting them? And number six, if regulators wanted to fuck our industry, they would. They did. Why did they bail us out and guarantee all deposits? They could have wiped us out in one move. So I think these are great points, and I tend to agree with that. Of course, I am very very suspicious of Nick Carter and his incentives in this whole thing. Can't trust Barney Frank. So I think David Bailey is on the money here. So what are your thoughts on this, Nolan?
I'm with you the same way. I saw Choke Point 2.0 when I read Nick Carter's first assessment of it. I was already a little worried when he first mentioned it. It's what I saw immediately on the weekend, and indeed, David Bailey's back and forth here changed my mind. And a few other points out there definitely did change my mind. But I will say this morning, this news out there that the sale of the business, perhaps it's a rumor, I haven't seen it confirmed, but this rumor out there that the actual rails, the Signet or whatever it's called, cannot be part of the um, business that's sold going forward is a bit of a red flag. Now, I don't understand the risk management bit. That just could be what it is. You have a company that's in a type of legal receivership. Maybe it is some form of regulatory risk that the New York superintendent has decided is supersedes the business case here. But it is rare that one business use case that a company has, if you're trying to be true and honest to any normal bankruptcy proceedings or liquidation proceedings or receivership proceedings, you should be looking for value in all of your products. So that is a form of prejudice that, while might have totally understandable reasons, does continue to put Nick Carter's theory in play. Now, I think it's a fog of war situation. Indeed, I think the points that David makes do change the scenario for me anyway, because they make it somewhat illogical. Indeed, if the point was to attack an industry, truthfully, why stop? Why help these banks in particular, right? There might be a reason. I'm not sure. We can't mind read these people, is what it comes down to. We can't mind read um, the folks in the New York superintendent office. Indeed, there was a reason to go in there. It's not exactly as Mr. Frank says, right? The way Mr.
Yeah.
Frank said it, and I remember reading Nick Carter's initial Twitter thread, which went out in this fog of war, and he started with "Dear God," something very dramatic, and saying "Whoa," and that definitely got my attention. I'll say I didn't take a full chew on it, right? I didn't say that's exactly what it is, and definitely could see that there were weasel words. There was some politics, even from Mr. Frank, right? How would he know necessarily? He's got his own reputation to look after. We're in a world of credentialists when it comes to these bankers, and not being caught with the bag is almost more important than not losing money when it comes to these, fictitious titles and all the things that make these banks go round. So, is Mr. Frank going to be invited to another bank directorship after this one's gone under? Well, probably, because we've seen them all
Probably.
at Silicon Valley Bank, right? Where wasn't everyone from Lehman Brothers and Bear Stearns and all these other places, and then they all ended up in Silicon Valley Bank. So it looks like you do get a couple kicks at the can. So yeah, what I see here is still we need more information, but definitely the prejudice against selling signatures, assets, and business lines, and specifically mentioning the crypto rails, does lead to more questions, right? I think what it comes down to is when you hear people like the president, right? The president of the United States, that great speech he gave the other day when he couldn't find the door and he couldn't take questions, and he can sort of make a sentence, but it was to say that the bank system was strong and to be assured that the bank system is strong, right? I think we're going to continue in this environment where there's low confidence and a lot of confusion and a lot of pricing that's just out of whack, right? What are these banks worth? What are these services worth? What are these assets worth?
Yeah. So my question is the Signet qualifier that was put into this supposedly a rescue package that they're putting together for Signature, or a rescue, I guess, bid. Someone wants to buy all their assets and stuff. Um, I think is that's like unofficial. That wasn't on anything
Yeah, yeah,
official.
yeah. I'm spreading rumors. Absolutely. Yeah, yeah, yeah. It's unofficial. I should have caveated that. I have no, it was another one of these fog of war things. You see people talking about it last night. You saw people talking about it today. You saw people making conclusions about a rumor. I have
Mhm.
not seen anything on paper that says they're not allowed to sell this, and I would not be surprised if it's a hoax.
Yeah, or
That that this.
it could be a political, person in the FDIC or whoever's made that comment
Mhm.
that they said to their underlings, "Oh, we're going to make sure they don't sell it with those Bitcoin rails," and then they go and leak that to the press or whatever. So
Yeah.
we don't know exactly what is going to happen from this, but my intuition, for as much as it's worth, is that that is just complete non-factual rumor. And I think that Signature will get bought. The Signet will get bought. It might even get broken off into its own thing, which would be good for the business. But like David Bailey says here, this was a bailout for the industry. They backed up all not only up to the 250,000 per depositor, but all deposits. So you could have had 2 million bucks in one of these banks, and you are getting made whole, which is a huge thing for all these investment funds, especially the VC funds that are all investing in this. So, I think Nick is completely disregarding 90% of the evidence and taking a 10% rumor and saying this proves my point. So, but very, very interesting stuff. And Bitcoin is breaking in to the mainstream. I mean, started with Silvergate, or FTX, of course, then Silvergate, then Silicon Valley, now to Signature. And this happens at the same time that Credit Suisse is having all these issues. I mean, Bitcoin is front and center on all of these people's minds, and we know
Not
that.
only not only front and center. What I would say it sticks out for me anyway is that because politics now are square over the target of the economy, U.S. style politics. So the politics of psyops, of division, of spin, of all of these things, of tribal warfare, right? It's one thing if it's in school policy. It's one thing if it's in energy policy and ESG and all these things that are sort of on the outside. But when it's squarely over the economy, it's a bad thing because we can't have conversations anymore. I saw Mike Solana, Pirate Wires guy. Now, it's a good thing for Bitcoin, and I'll explain. You see the Pirate Wires guy who came out and said, "Oh, the cool thing about this whole financial crisis is it's just confirming everyone's biases. Whatever you thought before, you're seeing it in the story." So, of course, everyone laughing that they're woke, the banks, right? Oh, the woke people, and so you get all these narratives out there. But one of the neat things is while everyone's fighting, and indeed the politics of division have entered the economic sphere now. So what was supposed to be an entity separate from the federal government, right? We, as we often said, not federal, not reserve, right? The Federal Reserve is neither federal nor a reserve. Um, it's actually bringing it closer to the political machine now, and in doing so, by bringing Fed policy closer to the political machine, you're getting it into the meat grinder. And the good news about Bitcoin is we don't fall into that meat grinder. Literally everything they're talking about is stuff we've already solved. Everything they're talking about is the foundation. All of their problems are the foundation of our system. And I made an interesting, like a simulation wink, right? Where we can call it us banking or US banking. So it's like the US or the us banking system, which literally now is just about Do you know someone? Are you close enough, right? Versus our banking system. And our banking system, not the us system, the our system really does promote these ideas of self custody and of not so much being your own bank, but being financially literate and understanding what saving your money and spending your money actually means in the economy. And so it's a type of awakening that Bitcoiners are going to get to benefit from. We're going to let the political system argue and cannibalize itself. And then the contrast that is formed with Bitcoin versus all this other stuff is perfect for us. I mean, Bitcoin shines brighter when everyone's fighting about politics and especially the politicization of the economic system. Good news. Very good news. And to watch Yellen, right, to watch fiat be down to its most elemental aspects, right? Fiat is obviously about words. It is built from words, right? It is 100% that.
Token.
It's decrees. And to watch it rest on the words of Joe Biden and Janet Yellen is a chef's kiss here. I mean, this is nice stuff, right? You can't hope for better as a Bitcoiner than to watch these two people try to suck life or pump life into the system. It's pretty good.
Yeah, I love that. Where Bitcoin is the source of truth. Bitcoin has a block. When that block is formed, you can check the proof of work and make sure it's valid. You can check a transaction that happened 5 years ago. The total supply. Like, these are sources of truth that aren't dependent on spin. Like, you don't have to, depend on an expert to tell you one way or the other. It's the truth, and so yeah, Bitcoin is a stark difference here. And I think, yeah, we couldn't have asked for a better highlight of what makes Bitcoin special as what we're getting right now.
And just as you said, Bitcoin is built off blocks, and now the building blocks of this system, the words and the people behind it, are becoming explicit. It's becoming explicit, and that's good, right? So that everyone knows, so that financial literacy can now be shared by seeing it, not by learning it in a school or learning it theoretically. We're seeing it in real time.
Absolutely. Okay, so let's move on to the next topic, and this is the ECB. They raised 50 basis points. Actually, Chris, I don't have a slide for this. I was just going to talk about it a little bit. So the ECB raised 50 basis points this morning, and nothing really happened to the market. We're going to see when we look at the charts, we're going to take a look at the German 10-year. We're going to take a look at some of these other things, but really, I think there's nothing to see here. This kind of ties into my whole thing, is that the market is in charge. That's what we've seen here with Signature. We've seen here with Credit Suisse. It doesn't matter that you get a bailout. Okay. The market is still going to interpret that as a failure. It's still going to have contagion because there's going to be less lending. There's going to be less borrowing. There's going to be less economic activity, all because of the possibility that there is an ounce of contagion out there. So when the ECB comes out and still raises 50 basis points after all that we've seen over the last 3-4 days, it doesn't matter. I mean, they're backed into a corner where they have to do something, right? If they pivot away from what they said they were going to do, 50 basis points, that's going to break confidence. But if they go ahead and raise it, and it doesn't matter, it's still, everything falls apart. I mean, at least they can go back and blame, hey, we raised too many times. Our instruments are just so powerful. We crashed the market. Whoopsie. So that saves some confidence in the ECB. But I know that the title of this episode is ECB Banking Crisis. I think we kind of covered that with the with Credit Suisse, and now the ECB raising 50 basis points, and nobody seems to care. So, any comment on the ECB?
Yeah, I think again, we talked about the politicization, but one of the aspects of that politicization of it is, and this is what I think has been really positive about this week about moving forward, is that the people who keyed into the words used a year ago, transitory, transitory, transitory. Remember, everyone said transitory. That was the main talking point for a whole year. It's transitory. It's transitory. Now, the game that looks like is being played out there by these people is they're saying, well, you're dumb and you listened to us. You shouldn't have listened to us because all the maturity mismatch that you have in your portfolio, all of the bonds you bought before and all of the bonds that are losing you money now and the bonds you'd like to buy today at a higher yield, but you don't have the cash for, all of that specter, which is exactly what Silicon Valley Bank did. They mismanaged their treasury, they mismanaged their risk. Um, all of that stuff is now, again, squarely bringing to mind what conjurings the Federal Reserve was using 2 years ago and what conjurings they're using today, and how they really are more or less saying, you idiots, you shouldn't have believed us. And to see that out there in the market, I mean, that's more or less what Christine Lagarde is saying today, right? You should have read through the lines. You should have watched this show because Bitcoiners knew what was going on. We said transitory is a scam from the beginning, right? And now it's easy to forget because we were sure of it at the time. So it's easy to forget that we were already warning that this was a trap and that you shouldn't follow it. But these banks did fall for it, and so having that conversation again is one of those things that's useful, and that's what I see with Lagarde here. She is almost, if you would put one of her interviews from 2 years ago up against this one, you can tell she's lying. There's no way around it anymore, right? So
We played a clip here where they asked her how she was going to get a hold of her balance sheet, and she didn't have an answer. She said, "Don't worry, it will come. Yes, it will come." And that's all she could say.
mhm.
They have no idea what they're doing. But you made a great point that, the market trusted the central banks, but they're only going to trust them so far because solvency matters. Credit Suisse showed us that, you can't put off insolvency forever. It's going to come and bite you. Reality of the market is going to come and bite you. But the central planners, they thought that they could mold expectations, that they could jabber the market to change their maturity matches or mismatches or whatever, and extend this to get the outcome they wanted. They're technocratic elites. They think that they can manipulate us like that. But no, the market is the ultimate arbiter, and that's what we're seeing right now. So yeah, great points. Okay, next up we have CPI and PPI. Should we get into that, Nolan, or do you have any other comments here on ECB?
No, let's jump into these ones.
All right, Chris, I do have slides for this one. So first up is going to be the CPI slide. Let's see which one that is. I think it's number 13, please. Yes, sir. Okay. So CPI came in as expected for February, and I'll just read out this report. So the consumer price index for all urban consumers rose 0.4% in February on a seasonally adjusted basis after increasing 0.5% in January. So it is a, disinflation here, or slowing of the acceleration of month over month. What else to say? The index for shelter was the largest contributor to the monthly overall increase, accounting for over 70% of the increase, with the indices for food, recreation, and household furnishings and operations also contributing. The food index increased 0.4% over the month, with the food at home index rising 0.3%. The energy index decreased 0.6% over the month, as the natural gas and fuel oil indices both declined. So we have a slowing of inflation. I thought it was going to be a little bit lower than this. I actually predicted 0.3 to 0.4 because the consensus was 0.4. That was the consensus forecast, and that's what it hit. So not any big surprise. Like I said, it's slowing back down from the quote unquote reacceleration that we saw in February. But all this goes together because a banking crisis is definitely not an inflationary scenario, right? It is a deflationary scenario where you are having the possibility of bank failures, and that will be a collapse in the money supply. Even if you don't get that, you get a bailout, which people think is money printing, right? People think that, oh, look at the Swiss National Bank, they're giving $50 billion to Credit Suisse. That's being printed out of nowhere. But it has to be paid back. The better question is, where do they get the money to pay it back? Okay, if it's printed by the Swiss National Bank, where does the money come from to pay back that loan? And they said it could be upwards of a year in duration, which is actually pretty long for a bailout loan. It's usually about, like, I think 3 months or something like that. So anyway, this all goes into a deflationary environment where there's a lot of contagion. People don't want to do business with other people. The plumbing in the system kind of freezes up. Credit is not created nearly as easily or as broadly. And so you have a contraction, a net contraction in credit creation, which is actual money supply. So, yeah, the CPI here, I wanted to tie that back into the credit creation and into the banking issues. But we do have PPI, which is the next slide. Like I said, PPI is upstream from CPI. It's what the producers are paying, and then the producers pass those on to the consumer. So, Chris, if we could get the next slide, please. So the producer price index comes out just like a day or two after the CPI. And this came out, and it was a decrease of 0.1%. A decrease. That means an outright deflationary move, not disinflationary, but deflationary. It was negative 0.1% in February. Let's see what else. Final demand prices advanced 0.3% in January and declined 0.2% in December. On an unadjusted basis, the final demand index rose 4.6% for the 12 months ended in February. In February, the decline in the total demand index was led by prices for final demand goods, which fell 0.2%. The index for final demand services edged down 0.1%. Going to the next slide, this is a tweet from a friend of the show, I guess. We've interviewed him twice here on the show, and he's one of my favorite commentators out there in macro. Jeff Schneider, he says, forget the US CPI or its core. That's riddled with rent estimates. And like I said, like we read out, 70% of CPI came from shelter, the shelter component, which is a huge lagging indicator, could be 12 to 18 months behind the rest of it. So he says disinflation is all over the US PPI, though that disinflation was last year. This year, it's outright deflation. Headline PPI down 2 of the last 3 months, yearly rate lowest since March of 2021. Then on the next slide, this is a image from another person we've interviewed here on FedWatch, Andreas Steno. Really, really like just rock star new analyst out there in macro. And he had this here. So I wanted to show this because of the actual versus the survey estimate, the consensus estimate. So PPI final demand month over month was negative, but the survey consensus estimate was positive 0.3%. That's huge. That's almost a full percentage point, or sorry, a full half a percentage point. For the PPI X food and energy, the actual was 0, and the survey was 0.4. Another gigantic miss. And then X food and energy trade month over month, actual was 0.2, and the survey estimate was 0.3, another miss to the downside. So if this is upstream from CPI, also CPI said that energy prices were a big negative for February for the CPI. We can see the CPI is going to crash. Okay, month over month, CPI is coming to an end, and tie this into all the banking issues that we're having. I mean, to me though, and Nolan, I know I'm going on a long time, but the other thing that I'll tie in here is that when we get this type of scenario where I don't think we're going to have an outright contagion collapse, at least not for the next 6 months. For the next 2 quarters, I think we're going to be smooth sailing. There's going to be bailouts. We're going to extend and pretend. Now, in that scenario, it's very huge for asset price inflation. So we're going to see stocks going up. We're probably going to see a rebound in housing because yields have gone down, which we'll take a look at the charts here in just a second. And we're going to see Bitcoin go up. We've already seen Bitcoin go up 35% just on this most recent bounce. So, yeah, that's what I got to say about the PPI and CPI. Nolan, back over to you. What are your comments on this?
Yeah, I mean, to me, it's more of the predicting Bitcoin. I totally with you. Predicting other assets, real estate. I think I'm there too. But to me, it's that psychological engine piece again. It's just leading us down the maze further into the labyrinth that fiat has created for people. More complicated, more financial engineering to get out, more trying to talk up the market, talk down the market. Because, of course, you're right. This is going to lead people to take on more risk because now they're going to say, well, deposits are all backed, right? We can risk this money. It's just going to throw it into the market. Come on, let's rock and roll. So I think you're in a situation where you're trying. You've got like school teachers. I like the school analogy. It's like because Janet Yellen reminds me of like a school teacher who's lost control, like a substitute high school teacher who's lost control of the class, right? And and she's just getting abused by all these bad kids, and it's like a really tough school. So you got her out there, and she's going to have to go out there now and say, like, don't do, no, don't do that, right? I know I gave you treats and candy at the beginning of class because you bugged me, but here you go. Like, just stop now. I gave you the treats already. You're supposed to do what I say. You're supposed to listen to me. I jacked you full of sugar. Listen to me, right? So that's what they're setting up. The school teacher has just jacked a bunch of rowdy kids with sugar and is going to tell them to sit still and listen. That's the plan. That's the plan as I see it. Now, I understand analogies only go so far and this and that, but that's what I see coming. They're jacking the system with a stimulant. That's the point of what they're doing. They're backstopping it, whether psychologically, they're trying to prevent a collapse, but also to prevent a collapse, it is to give a stimulant, right? And this was a type of defibrillator move that was done by backstopping. Because this is extreme, right? To backstop deposits in this way means you're de-risking the banks. They don't have to treasury manage. They don't have to manage their treasury anymore. It doesn't matter. Who cares? Every deposit is just a casino chip for them. And of course, people are going to abuse this. I mean, what did they say the helicopter was? 2 trillion? 2
That's what they
trillion
have. Yeah.
is 2 trillion is what is backstopped. Okay, so $2 trillion is going to be gambled by people who are told you can lose that much. Do you know what happens when someone gives a gambling addict money to burn in a casino? Guess what? You don't have to be a rocket scientist. You don't have to be Janet Yellen or Joe Biden. You don't have to be that smart to figure it out, right?
An expert. Yeah.
Experts aren't needed. So,
Yeah.
so that's what I'm seeing here. Is I look forward to these people, and I agree with you. I think they did extend and pretend, and my prediction has been for many years that the halving clock is winding and is in perfect synchronicity with the degradation of the fiat system.
Yeah.
And I continue to believe that Bitcoin, like you said, Bitcoin entering the mainstream, absolutely. I continue to predict that Bitcoin is going to be one of the most important presidential election questions in the 2024 presidential election. I think it's going to be front and center because it's going to be the only way to talk about this stuff in a way that's enthusiastic and positive, because otherwise you're sitting there trying to say who was right, Janet Yellen or David Sachs or Jerome Powell. Barney Frank. And, Jerome Powell, he was getting slammed all week because they asked him about the 2% number, right? The 2% target. And he's like, all right, well, lots of people have been doing it for years and it's what people like. And it's like, it looks good, right? Why do people have white fences, right? Why do people paint their fence white? I don't know, right? That's what he said. Like, that was his answer to something that's supposed to be fundamental to the whole machine running. It's like, what gasoline do you put in that race car? That's how they treat it. Like it's an F1 car, and it requires a specific formula of fuel. And if you're a little bit off, this finely tuned machine just won't work. Meanwhile, you could put chicken grease in it. You can put vegetable oil, gas. It doesn't matter. He's just trying to say it matters. It doesn't. Of course, it doesn't. Right.
Well, this is what I love about this show and about when you co-host, because we have kind of alternate like paths that we're taking to a very similar goal. So I see this as a deflationary pressure, as a banking crisis and a dollar shortage. And so that is going to chase people into monetary alternatives like Bitcoin and even gold. But also with the asset price inflation, why I think that is going to happen, and I've talked about this on the show, is that as as lending standards get tighter, the kind of like think of a garden hose and you open it wide open and it's just spraying everywhere. Okay, so that's credit when credit standards are loose. It's just spraying everywhere. But when you tighten that hose down, it's going to go in a tighter and tighter stream into specific asset classes. Margin accounts for these big trading firms, they are going to get funded because it's a pretty good sell to the banker to say, look, we're going to go long on this stock and we know they're going to do stock buybacks. I mean, it's a win-win for everybody. We can't lose. So it gets funneled into the stock market. It gets funneled into housing because you have collateral, right? The house it's the collateral for the loan itself. So it's a little bit less risky. So you have direct, injection of inflation right into the housing market, and bonds too, because as people flee to safety, as the rest of the economy is breaking down, people are going to flee to the safety of treasuries. So that's how I see asset price inflation, is a tightening of the water hose spigot down into those specific industries. So, but anyway, that's all I have for the CPI PPI. Should we get into the charts here? We got 5 minutes left. I think we can do it. Before we get into this, guys, I just want to apologize one more time. I am in the woods and I have the best connection I can have. So hopefully I'm not too jittery here and too breaking up. But Chris,
your audio is great. You're a little sketchy on the video, but it hasn't been a problem at all.
All right, great. Thanks. Okay, so for Bitcoin, here's the daily chart. Bounced very, very nicely, almost as if TA matters. Okay, we bounced very nicely off the 200-day moving average, and we broke up to new highs. Like I said, this most recent bounce was 35%. I don't know how anybody can look at a 35% bounce in Bitcoin and think stocks are not going to follow. And I tweeted that out. And of course, people are probably like, what are you talking about? Credit Suisse is collapsing. The stock market's going to collapse. Well, no, because like I said, asset price inflation, where's money going to go? Money is going to go to the most credit-worthy uses. And right now, that's going to be things like stocks. So any comments on the Bitcoin chart, what you see here, Nolan?
No, I'm reading the same, and I do continue to see the correlation. It was nice that Bitcoin did seem to separate from the broader market this week, but it was an enjoy it while you can situation. I think we get risen on the main tides like everything else for a little while. For me, the disconnect doesn't happen until we really start wedging the difference between our vision of the future, energy, and all of those things. But again, that's a 2024 thing as far as my calculations go.
Yeah, and with the signature bank and all these on-ramps that are supposedly the choke point, that hurts crypto, but that doesn't hurt Bitcoin, because Bitcoin demand is pretty consistent. So all you're doing is you're cutting supply. And you know what happens when you cut supply relative to demand? The price goes up. So I don't see that this choke point is bad for Bitcoin at all, if there is such a thing as the choke point 2.0.
America's becoming Nigeria, I guess. It's Nigeria.
Oh, with all the ATM and the capital controls, is that what you're
Yeah, well,
about?
they tried to. I mean, exactly. They tried to ban Bitcoin and cut off all the rails, and guess what happened, right?
Yeah. All right, next slide, please, Chris. Let's go to this one. I just threw in here because we just talked about the crypto choke point, but this is Ethereum to Bitcoin. I pointed out where the merge happened. Of course, you see that pre-merge pump where all the speculators get in before the merge happened. Once the merge has happened, it has been pretty much down. I think it's down 17, 18% now. Ultrasound money is down 18% against sound money.
What I always say, I try to keep it simple with the merge. They took the energy out of Ethereum.
Exactly.
They took the energy out.
Who needs energy? They depend. Yeah, energy. Plus, they depend on crypto. Depends on inflationary stimulus. That's what it's all just a reinvestment scheme from the original Ethereum pre-mine. And once you take inflation out of that, stimulus in that market goes away. That's why I think they, instead of minimum viable issuance, they should have done maximum viable issuance. Okay, next slide is slide number 10. And this is looking at U.S. Treasury yields. Like we talked about, they are crashing through the floor. They don't care what the Fed is signaling. They don't care what is going on with the ECB raising rates or whatever. They don't care about this. They're crashing. I have the red arrow here, and that wasn't last week, but it was on one of my live streams for Bitcoin and markets. I said, this looks like a blow off top type of behavior in the 10-year, when it is kind of going sideways and all of a sudden it spikes, then it comes back a little bit. I'm like, that looks like a blow off top. And that's right where it turned around. So these rates are way below the Fed funds target range. Let's keep going. And Nolan, you can interrupt if you have anything to add here. The next one is the 2-year, just more zoomed in, and you can see it's way below the Fed funds target range now and fell precipitously. The next one is the German 10-year Bund. And that red line way up at the top that you can barely see, that is the ECB target, 3.5%. And the 10-year is down at, what is that? Is it 2.2? It's too small for me to read. I believe it was 2.2 when I looked at it last. So pretty big, significant difference there. Again, the market does not care what the central banks are doing. And that's all my charts for this week. So light on the charts this week, Nolan. Any comments on those?
Yeah, I think the charts and thinking about the risk management of people predicting this stuff, and a lot of what we were talking about today, this new opportunity for the financial risk managers inside of the banks to fail all over again, right? They can just another kick at the can to fail. But what it makes me think of is that, and this is where that contrast again between Bitcoin and everything else becomes so important for me, is that Bitcoiners have been talking about this and telling about this future. It's not just you who got it right the past few weeks. Bitcoiners in general have been saying since the financial crisis, this is what we're headed towards. This is where it's going. And in that way, as every one of these shakedowns happen, these shakeouts happen, as the market twists and everyone bought transitory and then sold bailout and all of this stuff, the way I think about it is that Bitcoiners are still all playable characters. Like, we don't lose playable characters in this whole fight because of FTX. We don't lose playable characters because of risk management at banks. We don't lose playable characters because of what's going on with Terra Luna and Swiss Bank being the same thing. It doesn't make a difference because we're on our timeline. We still are at the table. We're still playable characters. And more of these Wall Street types, more and more of the experts, more and more of the central bankers confirm their non-playable category, their non-playable character status. Because if you actually are sitting here now telling me you are a financial risk manager and you are a victim of this transitory scam, and you were like, oh, I bought too much stuff a couple of years ago, but you guys said it was great, you're out. You're done. Like, you don't get to come around the next time just because no one will take you seriously, and you're probably broke, right? So it's the have fun being poor meme that will continue to push forward for these people who just don't get it. And all of this reality is just going to help open people's eye. And it's a great awakening, right? It's a great awakening to what banks are, to what money is, and to what Bitcoin is. And I think we're on schedule. And the more I see these opportunities for people with the bailout and the stock buybacks and the new risk stuff, and this guy's going to bail us out, it's great. Let's encourage it. Let's encourage Yellen to keep going around on her barnstorming mission to provoke and incite confidence. And let's get more Joe Biden out there trying to assure us all of the system, because it's beautiful. It really looks great.
Awesome. Well, Nolan, thank you so much for joining us once again this week. I think CK is going to be back next week, but I could be wrong about that. So I will be back in Civilization next week as well. So better audio and video quality for me. But any final words, Nolan? You want to plug anything?
Yeah, join us 8 a.m. Eastern Time every day on YouTube. It is a playback on Rumble. We go live on Twitter as well. For the breakup, it's all about the psychological formation around the debates that we see every day in the news. It's about psyops. It's about what Bitcoin is built off of. It's about the foundation of Bitcoin remember, dollars and Bitcoin are all psychological commodities, right? And our psychology remains more intact and stronger and ready to handle this stuff because we said it was coming. And Ansel, you've been giving good advice to everyone who's been listening for the past little while. So tune in here if you want the good predictions that don't lead you astray.
Thank you. Yeah. And FedWatch has never sold a scam. We've never sold any sort of ICO or DeFi project or anything like that. So you can trust this honest information from FedWatch. So I appreciate Nolan for coming on, guys. You guys can check out bitcoinandmarkets.com for more of my content. I do a relatively close to daily live stream. Of course, I'm on vacation this week, but yeah, so check out bitcoinandmarkets.com for more. All right, thanks. Take it away, Chris.